Japan grew at roughly sort of half a percent GDP growth over the following decades, and I'm saying that I'm going slightly out on a limb here, that China actually will be pushed to deliver that economic growth.
Welcome back to Breakout from Breaking Views, brought to you by PGIM. I'm Peter Thal Larsen, the global editor of Breaking Views, and joined once again from his study in the west of England, Edward Chancellor. Hi, Eddie.
Nice to see you, Peter.
So Eddie, so this week you've been writing for us about China, the Chinese economy, and particularly the sort of prospect of a slowdown and a comparison with Japan, bursting of a bubble, and a comparison with Japan that then leads to several lost decades. So maybe just start by telling us a little bit about why that comparison sort of makes sense at the moment.
Well, as we know, the real estate market in China is in turmoil. I think in over the last few days, Country Garden, the second largest real estate developer, has defaulted on its bonds to American investors, and that follows the collapse of Evergrande, the largest developer. So we've got a real estate crisis. It seems to be there. You see very low falling turnover in Chinese real estate and falling prices. Now, as you're aware, the real estate has been the driving force of China's economy, combined with infrastructure investment, since the global financial crisis, since stimulus package was launched in November 2008. Now, a couple of years ago, President Xi wanted to bring the housing bubble to an end. He'd earlier said that housing is for living in, not speculation, which is a perfectly reasonable point. The trouble is, when China's real estate bubble, or whatever you want to call it, is more inflated, to my mind, than Japan's was in 1990. And in the piece, I mentioned two metrics. One is just simply valuation. Remember, Japan's real estate was the stuff of legends, the Imperial Palace in Tokyo being worth more than California, so it was said. But if you look at it in aggregate, and Savills crunched numbers, I don't know if they're accurate or not, but it looks as if at the end of last year, China's real estate was valued at around 550% of GDP. Now, if you look at Japan in 1990, also on Savills figures, comes to about 480. So it's a significantly larger bubble by valuation.
So you've got so there are these parallels, right? And you actually make the point very well that China's actually invested more than Japan, and actually is more dependent on a lot of household savings that is being channeled into this investment and so forth. And so,
Peter, stop you. So I mean, the simple way of putting that is that the imbalances, the economic and financial imbalances, excessive investment, excessive savings, incredibly depressed household spending, excessive amount of debt, they're all more extreme in China than in Japan in 1990. The only metric, which actually I don't mention in the piece, is Japan's households had slightly more debt relative to GDP than China's do today. But as I do mention in the piece, Japan was actually much richer than China in 1990. Its GDP per capita, measured in constant dollars, it was actually twice what China is today. So a more developed country, in principle, is able to bear more debt. So China is extremely indebted, has an extremely large real estate bubble for an extreme economic imbalances for a relatively poor country.
Yeah. So I mean, people have been talking about this problem in China for a long time. I mean, for almost for decades, and so far.
Centuries, I say. Apparently, Karl Marx predicted the collapse of the Qing Empire in 1853, and he was a mere 4 decades too soon. And people have been saying, Gordon Chang's The Coming Collapse of China, put out in 2002. And then, there were books on China's banking crisis at roughly the same time. So these forecasts, let's say, were early at best.
Right, but there is a big difference, which is sort of one of the points you make, is that why are things more serious? And you point really to the way in which China is governed and run, and has been over the last sort of 10 years or so.
Yes, I cite a book by Yasheng Huang, who's professor at the MIT Sloan School of Business, called The Rise and Fall of the East. And what Huang, the argument he's making in this book, is that really the reform period that was inaugurated by Deng Xiaoping in 1978, in which the regions were given autonomy to pursue economic growth as they saw fit. They competed with each other. You can think of Guangdong province and so on, and they set up, if you remember, all those special economic zones and so forth. That era, and private business was encouraged. That era is really over, according to Huang, and he sees Xi Jinping's autocratic rule as a reversion to the type of rule that has really existed in China for hundreds of years in the imperial, under various imperial dynasties. And the point about that is that China's society traditionally was one in which commerce was despised by the Mandarin rulers and suppressed. And we're seeing that again in the name of Xi's common prosperity. I mentioned in the piece, you remember, a couple of years ago, you had the private tutoring companies undermined by Xi. You had the pulling of the IPO of Ant Financial and Jacques-Marc for a while going into hiding. You had Tencent more recently, really at the same time being required to give $15 billion to the government's sort of social inequality campaign. I mean, it's not a small sum of money, even for a successful company like Tencent.
Yeah. But bring it back to the economy. So I mean, you could say some of these things, particularly on the property sector, measures on the property sector, in an attempt to sort of address the problem and to rein in some of the excesses of the bubble. But I suppose sort of trying to throw it forward a bit. What does this lead to, and where does this leave China potentially?
Well, it's difficult to say. I mean, go back to the problem that people calling the collapse of China too early. China has, and again, this is a legacy of the imperial tradition, a capacity to hold itself together, and so and perhaps that will help. Perhaps the party rule will be secure. I mean, these dynasties often lasted for several hundred years, and so that's one alternative. But the other possibility is, if the state doesn't deliver economic growth, then the social discord that lies under the surface in China could come to the fore. But either way, from the way I see it, is that China is following the Japan path, or set to follow the Japan path, of a prolonged period of low economic growth. If after, and bear in mind, the demographic situation, declining workforce is the same. Is the same in Japan in the 1990s as it is in China today. Now, Japan grew at roughly sort of 0.5% GDP growth over the following decades, and I'm saying that I'm going slightly out on a limb here, that China actually will be pushed to deliver that economic growth. I mean, it may be that because it's a less developed economy, it can still go on a bit further. But I think I'm pretty sure now that the China economic miracle is over, and that has huge consequences for investors to think about.
Yeah, Eddie, fascinating as always. We'll leave it there and talk to you again very soon.
Okay, thanks.